Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I'm here with a slightly special update about the month of October. Now, as we know, October can see rather significant events in global financial markets. It has a habit of doing that. I'm young enough to remember actually the October crash of 1987. And for people who weren't around trading at that time.
Hi traders, and thanks for watching. We'd like to take this opportunity to thank our incredible viewers for tuning into our channel. We would greatly appreciate it if you could hit that subscribe button, as we're pushing for the 10,000 subscriber mark by the end of the year. Now back to the video.
It is a stark reminder of how quickly markets really can move. And it's part of the reason why I'm always suggesting defense if I think there's a bit of a problem on the horizon, because things can move very, very quickly indeed. In fact, in October 1987, and by the way, I'm wearing my New York Stock Exchange tie. I was on the floor of the New York Stock Exchange briefly in 1987, not in October, but preceding. I also visited Drexel Burnham Lambert's trading room, which was one of the biggest trading rooms in the world at the time. And if you're wondering why that name doesn't ring a bell for you, it's because they went out of business as a result, and partly due to the October 87 crash and very leveraged positions in structured bond markets. Now, I had a friend who was a very respected and senior trader on the futures floor, the Sydney Futures Exchange. We used to do the old-fashioned outcry system. Anyway, on that morning, he'd been very successful. He worked for a major company. But of course, if you're trading in the pit as a local, you're taking personal risk as well as company risk. He was backed by a respectable investment bank style organization. He went to work as usual in the morning, driving his Porsche, would you believe it? It's a very classic story, from his luxurious North Shore home. At the end of the day, and this is in 1 day's trading, at the end of the day, senior management and security walked up to him at his desk, confiscated all his credit. It was like a scene out of a movie. Confiscated all his credit cards and his car keys. And he actually had to walk home. So imagine that, just in the case of 1 day, going from driving your Porsche to work to not even being able to afford bus fare and walking home at the end of the day. Of course, he was a bit shell-shocked and shaken and didn't actually ask anyone to lend him the bus fare to go home, and perhaps the walk was exactly what he needed, because he did eventually get back on his feet. But that gives you an idea of how fast markets can move. And if you don't remember that time, what actually happened was that markets, I think it was the AUS 200, fell 50% in 3 days. So that's a big movement. Yes, you heard me right, 50%. Might have been over a week, but I think it was over 3 days. It felt like 3 days. At the time, I was trading currencies for another French-Belgian investment bank in Australia. I was their principal position taker. And I actually had one of my best trading months of my career during that crisis. But I was trading currency markets, not the equity market. Would have been nice to have been bearish in the equity market, but who knows if I would have been, because my focus really was the US dollar and other currencies then. By the way, it was my biggest, most profitable trading month in terms of percentage performance on very large positions. And I only got 40% of my trades right. So just remember, when you're trading, there's all sorts of ways of looking at trading, And often the determination to keep re-establishing can be a good thing or a bad thing. And in that month, for me, it was a good thing. It meant I had a lot of small loss trades, but the trades that I let run were rather large and significant profits. So best month ever, 40% of trades right. As we approach October this time round, 2023, I actually have concerns that stretch to 2024, but there is some good news maybe for markets in 2024. May not be good news in some regards, but it will be good news for markets, I would suggest. But we'll get to that after the October key ideas that I have. So for October, I'm thinking, and remember, I've been bullish oil for quite some time. Well, I'm thinking oil could disappoint the rather extreme speculative long positioning that is now in play there. It's a little bit the case of the idea of oil having a very strong rally. Very few people accepted when I first started forecasting it several months ago. We've got that good run. We've had a very good run in oil to the upside, fabulous uptrend. But now all the people who didn't think oil would go back up are now bullish. And that's always a little bit of a worry. And when everyone thinks a market is going in one direction, that's time to begin to think about maybe some consolidation or correction. So that's what I'm feeling for oil in October. That oil could disappoint the bulls from here, and I'm one of the bulls. So, I mean, if oil can manage to consolidate here and again start to move higher, I will get involved and I will go long, but perhaps not in as big positions personally as I did a couple of months ago and even a couple of weeks ago. So I don't think the bull run in oil is over. That's not what I'm saying. I'm just saying that the market might have become rather long in terms of speculation, and that the real supply-demand structure in back of the market probably can't keep pace with these speculative gains, and therefore the price action can fall back to and then overshoot, of course, because that's what markets always do. The market is always wrong, remember. It's never right. That's why markets move. If markets were right, they wouldn't have to move. You wouldn't have volatility. The market is always wrong, but it is always highly active in seeking out and searching the right price for the existing supply and demand. But that's why we get volatility, and that's why we get overshoots. So I just think the oil price might have stretched a little bit high here, and now there's risk of consolidation to an overshoot possibly below the supply-demand curve to the downside. I tend to think we'll only see a momentary correction in oil and then it will be on the way up again, but I would suggest that for October, it could be more of a frustrating consolidation month for the oil bulls like myself, rather than the easy days of recent weeks. The other, well, not so surprising view that I have is that bond yields will keep rising in Europe and in the United States, regardless of what their central banks do. Now, I've spoken about this a lot, excuse me, in the daily reports or a few a week reports, but I do think it is worth noting as a big picture phenomena that bond yields will go higher, and this is the point, and I keep saying it, but maybe I don't emphasize it enough, regardless of what those central banks do. So it's all about risk off for bankers lending money. It doesn't matter if it's property, it doesn't matter if it's high rise in the United States, doesn't matter if it's business loans, doesn't matter if it's car loans. And remember, at the moment in the United States, car loan delinquencies are at the same level that they were in the GFC. Consumer sentiment is as bad as it was in the GFC. So there are all sorts of economic risks. And usually in that environment, you would expect interest rates to decline. but the Fed is going to keep them higher, as you all know, because of inflation. And I'm not going to spend much more time on that because I've spoken about it at length previously. But the Fed is going to keep rates higher, and that's creating a base upon which the private sector, the lenders, must factor in what they think the current risks are. So this is going to be a very unusual, economic slowdown, risk probably recession in the United States, where interest rates actually go up because from a very high baseline provided by the Federal Reserve, the major lenders are going to start or continue. They've been doing it, and they're going to continue to increase the margin that they require to lend money to any company, property owner, small business, consumer. So interest rates keep rising for the American people. And there's no stopping that, I would think, probably well into next year, but certainly for the rest of this year. So for October, yes, bond yields will continue to go up. One of the reasons bond yields might go up too is that both Chinese and Japanese buying of bonds, I suspect, is slowing rapidly. So they've certainly been major underpinning players to the US bond market over recent years, funding the US deficit. And as on the 1st of October, again, a little bit of a coincidence for my warnings about October here for the equity market, is the date that again the US government could run out of money and various federal programs could come to a complete halt. If that were to happen even for a few days, but certainly for a week, then the equity market would have to price that in rather aggressively. So there are risks for October. Also, running into October, there's the likelihood that inflation data will be even stronger, but certainly still firm. But that reacceleration from 3% to 3.7% for the headline number and the core number remaining high, and we get PC index, deflator index this Friday to start the month of October as well. If that's a high number, then markets are just going to be getting spooked in all sorts of ways. Economic slowdown, possible government closures, and the Fed possibly raising rates again very, very soon at the next meeting perhaps. All of this might just be a bit too much when it all comes together in the month of October. Now, paradoxically, higher bond yields will lead to a higher US dollar. So if you sort of put it all together, what we might actually see is that deteriorating US economic data actually generates a higher US dollar because there's not going to be any rate cuts as the economy slows, but the lenders are going to increase their margins for lending as economic data deteriorates. So that means the US will actually have higher interest rates just as the economy weakens further, which is something historically we haven't really seen in economics before. And I think these trends, which I've been warning of all year, are really going to be coming home to roost in the month of October. And I do think it is something to really keep an eye out for, that oil could plateau, but the full effects of the already seen oil price increase has not yet hit the inflation numbers. It's barely even showing up in the CPI yet. There's much more to come in that pipeline. That will keep the Fed on a tightening bias. The economy will continue to deteriorate, and you're going to see Chinese, Japanese buying of US bonds balking quite a bit, and you're going to see a building of margins. So US interest rates going much higher from the private sector, bond yields going higher. That supports the US dollar, which again makes it harder for the US economy when their dollar is so strong that they're starting to lose out on export markets. This is going to have another negative impact on the US economy. So I'm looking for further deterioration of the US economy in October, a movement higher in interest rates, a movement higher in the US dollar, particularly against the euro, because the European situation is becoming very difficult right now, and for oil prices to go sideways, but inflation to still accelerate. Now, how far could the equity market fall? Well, I think the AUS 200, the Australian market, could fall nearly 10% to around that 6,400 level, which is what it did last time it dropped out of the current range. It could even go further. That's not a big call. I mean, it's slightly less than 10% from where we are, but I do think we need to be aware of the big directional risk. The other thing that's unfolding, of course, in the US 500 index and in the NASDAQ is that some of the tech stocks are beginning to stumble, and that could weaken the US market overall. So I want to give a big warning about October. I hope I'm wrong. It would be good for my trading positions if I'm right, but I hope for the world I'm wrong. But I think we all need to take note that October could be the riskiest month of 2023. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.